Hey everyone, it's Rob B here with Rob D, and you are listening to the Property Podcast, and this week we get into a deep conversation. We talk about our beloved 18-year property cycle in a way we've never before. A warning, some people may find this episode upsetting.
Welcome to the Property Podcast. Thank you for joining us. In case you don't know, every year we buy more than £100 million worth of property for our clients and ourselves, and this is the show where we share some of what we've learned along the way. Today we are talking about the property cycle. Is it dead? Is it just resting? We share our views in this episode, and as Rob said, it is going to get a bit emotional.
It's time for our news story of the week, and we are going to talk about house building targets in the UK. Now, we have always had targets, but until very, very recently, in the last few days actually, they have been optional targets, more of a guiding or an aspiration, but Labour have changed things, and now those targets have become mandatory, and each council has to build a certain amount of properties, and it is actually broken down of what each area needs to deliver. Now, we're not going to get into that detail here, but the interesting thing is all these numbers added together, Rob, reaches 370,000 new homes each year. And remember, this is mandatory. Last year, we were at 230,000. So not quite double, but a huge increase from what we have been doing. And before it was optional. It'd be nice, guys, if you got there. And now it's mandatory for councils. I don't know what that means, Rob. I don't know what happens to the naughty councils that don't deliver their targets, but it's a big old number, that one. It'll be the biggest, certainly I'm aware of, that we've ever done in a single year. Certainly in our lifetimes, maybe after the Second World War, but that gives you an idea. In the 21 years we've both been alive, we've never hit that number.
No, I don't know what this means either. Presumably, councils can't be expected to magic houses up out of nowhere. It needs to be contingent on mostly private builders wanting to build them, but it means they can't just say a default no to schemes in the same way as they have done before. I've spoken to a couple of developers recently who've been trying to build on brownfield land, either demolish or repurpose something that's been there, and it's just sat in planning for months and months and months, and they've come back at the end and just said no, and not really given a reason. There's no appetite for building. Presumably what this target does is mean that they have to go, okay, fine, you can build whatever it is you want to build. I would still question, Rob, whether we will get to this magic 370,000, because I seem to remember in the past we've had governments come in and talk tough about this kind of thing, and it's never quite happened. But if it does happen, is that enough to put downward pressure on house prices because there's suddenly all this extra supply? I would strongly assume not, but it'll be interesting to see if we do get anywhere near this number, and if so, what the implications of that are.
And that's really interesting, Rob, because if you look at the data by area, which I've started to do, the cities don't have huge targets. In fact, London's target has been cut. So London's, would you mind if you could try to hit this number, please, was just short of 100,000, and now it's been reduced to a mandatory target of 80,000. That is not going to change the supply and demand dynamics in a city like London. And it's a similar story with other cities around the nation. And as you would expect, they are smaller than London's target. So these homes, it seems, are being targeted to be built outside of cities. Yes, cities do have targets, but it's outside the cities where this supply may eventually end up. I say may because, like you said, Rob, we've had big talk before and not big action. We'll see if this big talk actually translates into big action. Of course, we will keep you updated. And Rob, we should keep people updated on the Renters Reform Bill, or whatever it's called now.
No, we've got to correct you there. Renters' Rights Bill, please. Completely different instrument. Yes, the news here is no news. So according to David Cox, who used to be chief executive of Arla, we're not going to have any more details about this until October. I don't know how he knows this or quite how accurate this is, but if this is correct, it means we can all continue to hold our breath a bit longer to see exactly what's going to happen in terms of rental reform. But if it doesn't get moving to October, and then it's got to go through the whole process, and then there's going to be an implementation date, it's going to be a while. But there will be milestones along the way, and as more detail emerges, we'll update you on the podcast, of course. But to make sure you're always first in the know when it comes to property news, sign up to our newsletter, Property Pulse. Go to propertyhub.net/pulse, completely free, in your inbox every Friday. Why wouldn't you? Since the early days of this podcast, more than 10 years ago, we've been guided in our investment decisions by something called the 18-year property cycle. And while the property cycle should make property investment predictable and answer lots of questions about what you should do next, the cycle has actually generated more questions than anything else we've ever talked about on the show. Everyone always wants to know, where are we in the cycle? Is the cycle still on track? Will this affect it? Will that affect it? You know what? Recently, we've been having some doubts of our own. So we're giving this full episode over to the property cycle. We'll explain what's coming next, according to the man who discovered the cycle, and we'll explain the doubts we've been having and why. And I've not made my mind up about this going in, Rob, so hopefully by the end of this episode, we'll have come to a decision.
I think this is going to be a really interesting episode, Rob. I've got some thoughts that I've started to express elsewhere, and I'm glad I'm bringing it to the podcast. I think this episode's going to surprise a few people. But before we get into what we think about the 18-year property cycle, let's give a very quick recap. We've done lots of content on the 18-year property cycle before, so please, if this is a new concept to you, go and hunt that down, search for the 18-year property cycle. We've got courses on our website, we've done numerous podcasts, it's on YouTube. But, Rob, in less than a minute, can you sum up what is the 18-year property cycle? 18 years in less than 1 minute, go.
Right, so the idea is that property prices have booms and crashes. We all kind of know that, but it happens in a predictable way according to this cycle. And an entire cycle from crash to the next boom takes 18 years. So let's start from the height of the boom, the day that prices start to plummet. From there, it should take 4 years for prices to hit the bottom and stagnate. So 4 years of falling prices. You then have 7 years of prices mildly rising. You get steady growth as people regain their confidence. They see that prices have hit the bottom and banks regain their confidence and they start to lend again. There's then a mid-cycle wobble as things start to get ahead of themselves and prices have a bit of a dip. And you then get the second half of the cycle, the second set of 7 years, which is the more aggressive half of the cycle. Prices rise faster, reaching fever pitch in the final 2 years. The final 2 years are what's known as the winner's curse period. This is when fundamentals have gone out the window. People are buying purely because property is going up so fast and they're worried if they don't buy now, it's going to go up even further in the future. And of course, just when it seems like prices are always going to go up forever, everyone stops and goes, hang on a minute, why are we paying so much money for this terrible one-bed flat? And prices crash again, starting the next cycle. The key insight is, though, that you don't end up coming back to the same place that the previous cycle started. So after the crash, you still end up higher than the starting point of the previous cycle. So you can imagine over the long term, a smooth line with prices drifting upwards. But it's when you zoom in, you see that it's made up of these periods of growth followed by a correction. There's a reason for 18 years being a thing, but I think I've had my minute, Rob. I think that's what people need to know to get the most out of this episode.
If you're listening on 2 times speed, that was definitely a minute. Well done, Rob. I would have taken 5, so you did much better than me. What's important to stress early on is the reason we've given this so much attention over the years, and podcasting for over 10 years now, I've been talking about the 18-year property cycle for many years, is that it's worked surprisingly well. If you go back through history, the last cycle, the cycle before that, the 18-year property cycle has held true. And it's not always exactly 18 years, but if it isn't, it's close. So it's really interesting to follow. And it's not just that, the market went up at this point and crashed at this point. Each part of the cycle that Rob's just given you detail of has played out as well. And after 2007, when we kickstarted the new cycle in 2008, you looked at the beginning of the cycle, it was like, wow, this is playing out again. So that's why we gave it so much attention. That's why we gave it so much coverage. And you could get confidence from the 18-year property cycle because the media, understandably, would point to the extremes. The market's going to boom, the market's going to crash. That's kind of their job, right? To make it exciting. But the 18-year property cycle just allowed you to stay calm because you could say, wait a minute, this has happened before and this is playing out again. And Fred Harrison is the gentleman, the economist, who's popularised the 18-year property cycle. He's become reasonably famous off the back of making predictions using the 18-year property cycle. He correctly predicted the 2008 crash, and he correctly predicted the crash before. But he didn't just say it a few months in advance. He said it years in advance. And he even got it down to the quarter the property market would crash in the last cycle, years in advance again. it's almost spooky levels of accuracy that Fred Harrison has been able to achieve by using the 18-year property cycle. So with all that said, why are we even having this conversation, Rob? Let's talk about how we feel about the 18-year property cycle and discuss why we're questioning it or taking a different view potentially. What is it for you that's wanted to make you turn on the microphone today and chat about the 18-year property cycle? Surely it just carries on because Fred Harrison has said it's working still.
Yes, in Fred Harrison's latest interview, the most recent we could find, which was a few months ago as of the time of this recording, he said that prices will rise about 20% before a major crash in 2026. So 2026 minus 18 is, of course, 2008, which is the time of the last crash. So Fred Harrison believing that the property cycle is staying exactly on track. It's going to be exactly 18 years. So this cycle will run for exactly 18 years. So why have doubts? I'll give the high level of my doubts, then we can have a chat about it and we can get into more detail. But I think mine boil down to two different things. One is that 2 years from where we are now into a gigantic boom, and such a boom that it then precipitates a crash, doesn't seem long. It doesn't seem long at all. Now, we know that when a boom gets going, it gets going very quickly. That is true if you go back and look at the last couple of cycles. But at the moment, where we are now, we're absolutely nowhere near a boom. It's not like we've been in like a reasonably strong rise and then suddenly prices are going to go bonkers. I'm not saying it can't happen, but I'm saying it seems unlikely given where we are now. And my second reason is that you said earlier, it's not just the 18 years part that's played out over the last few cycles. It's all the different milestones along the way, all the different phases. And I think it's very hard to say that that's happened this time round. Yes, we had the crash. Yes, it probably took about 4 years for prices to bottom out and then start to increase again at a national level. It happened at different speeds in different places. But that would have taken us to 2012-13. That's a long time ago now. Property prices have not done much since then. I didn't see a mid-cycle dip. I haven't seen prices starting to grow more aggressively since then. I've not seen any of those milestones. And of course, we have to say the C word. We've had COVID in there as well, which threw a major spanner into the works. So I've got more thoughts, Rob. But for now, those are my headlines. I'm keen to hear yours.
Well, Rob, you're right. The cycle, as you've outlined, towards the end, you see 7 years of quite strong growth. The last 7 years are strong, pushing on. And then the final 2 are the winner's curse. And that means if 2026 is the year we're going to have the crash, we have the winner's curse. It should also mean that we've had 5 years of big gains. But let's remind everyone of what's happened. So we go back to last year. The property market, and this is all nationwide data, the property market fell by 2.3%. In 2022, it was up by 4.8%. 21, 10.1. Okay. And 20, 6.4. And 2019, 0.8. So you are up over the last 5 years. But except for the year of 10%, none of them have been stellar years. Some solid years. Most of them are average or below average. But only 1 year where you've gone, wow, that was big growth. But what you also must take into consideration, dear listener, is we've had excessive inflation during that period as well. So in real terms, property values have fallen during that period. Fallen in real terms. So when you look at house prices alone, that can be misleading if you have inflation at play, which we absolutely have. We're still just coming out of that at the moment, and there's predictions there may be more to come. So in real terms, property prices have not gone on a boom, but even if you just take property prices by themselves, they still haven't boomed. Now, you may be going, but Rob, what about that year of 10%? Well, let me take you back to the last cycle, because it was quite a different run-up. It very much matched the last 18-year property cycle. So in 2000, we had growth of 9.4. 2001, 13.4. So bigger than any year that we've had recently. 2002, 25% in 1 year. 2003, 15%. 2004, 14%. And then 2005, it started to calm down, 3.2%. Now, growth of 9.4, 13.4, 25, 15, 14, that's a boom. If you have 1 year, you go, wow, that was a crazy year. When you have year after year at that level, that is absolutely a boom. We've not had anything close to that. The most growth that we've had at 10% over the last few years isn't even half of the most growth in that cycle. And in some years, as I've already said, we've had prices falling and in real terms, actually properly falling overall. So the 18-year property cycle is not happening. If you break it down to each section, which is what the 18-year cycle is all about, it's not just the start and an end point, it's about the phases in between, and those phases have not happened. And as you've rightly said, Rob, you nearly always need a boom to have a bust. Like, you need that mania to happen for a bust to occur, and that is clearly not happening right now, not even close to happening. And you could argue, even if we do have 20% growth over the next 2 years, we had more than that in 1 year in the last cycle.
Exactly. I can't spot any cases in the historical data of prices going up 2%, up 3%, down 20%. It's never happened. You've always had the aggressive growth before the crash. So for this to play out, you do need to pack a proper boom and a crash into the next 2 years. Maybe you can say, oh, well, it'll just run a bit long. And I think that is a potential argument, and we can come back to that. You said earlier correctly, 18 years is just an average. So we can come back to, well, how far away from 18 years is acceptable and still say that this has worked? But if it's not playing out, why might it not be playing out? So Fred Harrison claims evidence going back hundreds of years for the cycle playing out. I actually went back and revisited his book last week to look at some of that data. And it is tricky because the cycle's worked really well since the 70s. Prior to that, he's basically saying, oh, well, the world wars knocked the cycle off track and then it took time to get back on track. And so by the time you go back to before the wars, you're back into a period where the data is nowhere near as reliable as we had today. So there might not be quite the weight of historical evidence that it first seems. But even if there was, there is an argument, I think, that things are different enough now that we're not seeing this play out now and we won't do in the future. And I could sum that up in a word as intervention. So we now have a highly financialized economy. We have a very large proportion of the population owning houses. So house prices, house values, perceptions around house prices, all this stuff is more important to the economy than it ever has been before. And as a result of that and other factors, we see more intervention in the economy than ever before. Not just changing interest rates, which has always happened, but also dropping huge amounts of money into the economy to keep it going whenever it struggles. And we saw that in 2020. With COVID, and the money that was printed, the interventions there were a large part of the reason for the inflation that you referenced earlier, Rob. And we also saw it in 2007, 2008 with the financial crisis. That was the first time that anyone had heard of quantitative easing, which again is large-scale intervention. It's money printing. It's trying to keep the economy propped up. So I think you could make the case that whatever natural cycle there is that's in play isn't allowed to play out anymore. And for me, if we are saying the cycle's just not working this time, maybe that's why. It's because since the last cycle ended in 2008, we've seen so much intervention that all bets are off effectively.
So, Rob, are you wiping your hands with the 18-year property cycle? That was really interesting. It's worked before, but for now, for the time being, it's just not for me. Is that what you're saying? Or are you still open to using the 18-year property cycle in this cycle in some capacity?
I think whatever happens, whatever we talk about for the next 5 minutes, I think there is still something very useful to take away from the overall concept of property being cyclical. But throwing out the time element and hanging on to the cyclicality, if that's a word. But do we need to throw out the 18 years? It's that point about how wrong can it be while still being right? And I personally draw the line at 2 years. I'd give it 2 years leeway. So I think if you do have a boom and then a crash by 2028, you could probably go, fair enough. So COVID basically put everything on pause for a bit. So you had this period where prices spiked and came down a bit. You have to write those couple of years off. Then things got started again and away you go. And I think that's being generous. If it's any longer than that, I think we have to conclude that the cycle didn't work out. If in 2032 you suddenly get a crash, you go, ha, told you so. It just doesn't work. So that's my view. I'm keen to hear yours. And I'm also keen to know, based on your feelings on it now, does the cycle add anything for you? Does this notion of the 2026 date or even a potential 2028 date, if you say, oh, well, it's delayed a bit, that's still fine. Does that lead you to do anything differently from what you'd have done if you never heard about the cycle?
Okay, so let's start with where I'm at with the cycle. For me, I am done with it this time around. I think it's broken. is probably the nicest way to put it. We're talking about the 18-year cycle like it's a person. Don't want to hurt its feelings. But unfortunately, Mr. 18-year or Mrs. 18-year property cycle, you are broken in my mind. And it doesn't work because you said it might be generous 2028. And I think that would be a generous interpretation, Rob, because just having a boom and a crash doesn't mean it's a cycle, because the reason why the 18-year property cycle was so useful in the past and we gave it so much attention over the years is breaking it down bit by bit. So going, okay, this part of the cycle, you can expect to see this type of behavior in the property market. But having a quick 4-year surge and then bust, that's not the 18-year property cycle. We're meant to have a 7-year run-up or around 7 years. So doing it in 4 after property prices being negative in real terms for so long, I think it would be a generous interpretation. I couldn't argue that, no, you are wrong, but I think it would be generous. For me, I wouldn't call that the 18-year property cycle. I am only done with it for now, though, because I do believe it's an interesting pattern. I do believe that the beginning of this cycle was reasonably accurate compared to what you would expect, and even a few years after that, but it broke in the middle. And then it really broke, as you've highlighted already, with COVID. And COVID was our war. Yes, we didn't have to go to the front line. And yes, it wasn't anything as traumatic as the Second World War, but it was still traumatic. And it was still a huge life event for all of us. And that meant that the economy had to change. And it did change. And it changed in a way that's really derailed, for me, the 18-year property cycle. Now, maybe my generous interpretation of this is that's what broke it. I'm giving it a reason, and I'm being generous to the cycle by saying, oh, it would have worked, but that's what broke it. Whether that was what broke it or not, I think doesn't matter. What I do feel is that it is broken. And that means, for me now, I'm ignoring it as a concept until we eventually do have a boom, which will come. This is not me saying we won't have a boom. And then eventually a crash will happen as well. And that's when I'll probably pay more attention to it again after we've finalised this cycle, however long it lasts. But it seems like it's got some legs yet. And I think 2028 would be unlikely to occur. Not impossible, unlikely, because you just need such a big run-up before then, and we're far from it at the moment. So that's my first point. To answer your second point, what would I do if I still believed in the 18-year property cycle, and would I be changing my investment? Well, at the moment, no, because in the 18-year property cycle, the final 2 years, they're the gains that are wiped out. The cycle, you can invest for 16 of the 18, and I believe at the moment we are not in a winner's curse. So I today would be investing as normal, and as the boom starts, I would invest in as normal, because the 18-year property cycle suggests that you have a 7-year boom, and it's only the last 2 years you need to be cautious. So I think a lot of people have made the mistake in the past, and absolutely did make the mistake in the past cycle, of getting out too early. Now, the people who got all the headlines were the ones who got out too late, and you could rightly argue that if you got out too early, it's better than getting out too late. However, I think actually neither are good outcomes. You want to invest all the way until 2005 in the last cycle and then stop. That is easier said than done, but that's the beauty of the 18-year property cycle. If we can believe in it, it gives us that guidance and then that confidence to invest right up to that point. But I feel that this time around, it doesn't exist. That guide is not there, and it's been super useful to cover over the years. But for this time around, I'm done with the 18-year property cycle. That's kind of a big thing, because we've been big supporters and advocates of it over the years. But for now, I just think it's done. And maybe next time, and I'll give it a chance next time. I'm not saying it's done forever, but I'm done for now.
I'm feeling quite emotional about it, Rob. It does feel like a breakup. We've been talking about it for such a long time.
I hope Fred's not listening. I feel quite bad.
I know. Well, he'd hate the fact that we're using it to profit from property, because his whole argument is that the whole thing is wrong and should be stamped out. So if we do indeed ignore the cycle, lose the faith, and then lose loads of money, he'd be delighted about that. So maybe Fred will have the last laugh. Am I ready to say I'm done with it? I'm probably not ready to say it, but I probably am through my actions, which is that the years passing as we tick towards 2026, which, as we've already said, is when Fred Harrison says the peak will be, that doesn't do anything for me. I'm attaching no importance to that date. I'm going to be guided purely by what I see happening in the world around me. So if I really believed in the cycle for this time round, I'd be getting out now. 2 years to the peak. History tells us that you want to avoid the last 2 years. Therefore, I'm getting out now. This is the high point. But I just don't believe that at all. But like you said, Rob, a boom will come. And when that boom comes, I will then hopefully not get carried away by that and hopefully draw on my knowledge of what's played out in the past, not to get carried away and to be smart in that boom, knowing that a crash is on the other side and knowing that that is when the real opportunities in property are. But I'm going to be looking at the world around me rather than at the calendar to come to that judgment. So I guess without putting it in so many words, from my actions, I'm kind of saying I'm done with it too.
Wow, Rob, I feel like we've just broken up with the 18-year property cycle.
Yeah.
It's not you, it's us. We've taken people on a journey with the 18-year property cycle, especially our long-term listeners. So I'd be really keen to hear everyone else's thoughts on this. Do you think it's broken or do you think it's still working? We'll post it in our socials today. So when the podcast goes out on the Thursday, look for our socials at Property Hub UK across different platforms. We'll put a poll out. We want to know what you think. Is the 18-year property cycle alive and kicking, or is it broken or even dead? We want to hear from you. Let's hear what you have to say. We've given you our case point, and I think that's a big movement and a big shift from where we've been previously. But I'm really keen to hear what everyone else thinks. So check out the polls on our social platforms. And if you're not following, well, you may as well while you're there.
Okay, so it's been an emotional episode. I feel like I need to distract myself with something. So let's throw in a hub extra before we finish. The part of the show where we bring you a tip, a tool, a resource, something to make your life a little bit better. And this week we've got a website that I don't believe we've ever mentioned before. I can't believe we've never mentioned before because I've been using this for years, which is camelcamelcamel.com. Now, the name does not give much away, so I'll tell you what it does, which is basically a price tracker for Amazon. So the prices of some items on Amazon can bounce around by a lot. So you might not know if the price that it is right now is reasonable, if it's historically high or low. And if you're not in a rush, you might be prepared to wait a bit to get a lower price. So if you take the web address of that product and you pop it into camel, it will then show you the price history of that item. So it will show you a chart over time. It'll show you the highest it's ever been and the lowest it's ever been. And that in itself is quite cool. So I'm looking at the protein powder that I regularly get, and I can see at the moment it's slap bang in the middle. It's £38. It's been as high as 55, as low as 24. That is pretty normal. But if I'm not running out, I can see that occasionally it goes as low as 30. So I can then go and set an alert. So I can say notify me when the price drops below £30. And it will then send me an email if that happens, so I can go and snap it up while it's a bargain. So we're all very conditioned to wanting something and getting it straight away by now, but for anything where you're not in a rush, or for anything where you use it regularly and you can take advantage of price drops to stock up for the future, Camel is really useful.
Love that resource. That's a brand new one for me, so I will be checking that out. Thank you, Rob. And thank you, dear listener, for sticking to the end of the show. And if you've made it this far, you clearly love Property Hub. So as a reminder, our amazing newsletter is available for you for free, written by Rob Dees Fairhand. It's propertyhub.net/pulse. Make sure you've signed up for that. Make sure you check us out on Sunday in the Sunday Times, where we'll be answering more of your questions. We'll be back on Tuesday to answer more again in Ask Rob and Rob. And of course, next Thursday with the Property Podcast. So until all these wonderful events occur, take care, have fun. Bye-bye.
Bye-bye.